go through. I'll just share my screen here so you can actually see that, and we'll kick off.
So thank you so much, everyone, for coming on board to the Cake Equity Workshop, exclusive member workshop for climate tech companies. My name is Charlotte Connell. I'm the head of engagement here at Climate Salad. We've also got our wonderful founder, Mick Levinskas, on the line, as well as one of our incredible advisors, Jackie Bond. To get started, I'd like to acknowledge the traditional owners on the land of which we meet. For me, that's the Gubbi Gubbi people, and I pay my respects to their elders past, present and emerging. And that's about as much as you'll hear from me until I'll give a plug for our Melbourne Climate Tech Showcase at the end of this, but I'll hand over to Cal.
Thanks, Charlotte. Can you hear me okay? Can everyone else hear me? Awesome. Thanks, Mick.
Loud and clear.
Yeah, thanks very much. Excited to be talking to you about our favourite subject, which is capital raising. I'll just share my screen and hopefully this will come up properly and we'll get going. How long have we got all up, Charlotte?
Oh,
about an hour.
About an hour, but yeah, you know, we would like to have these as a bit of a lunch and learn over your lunch break.
Awesome.
So if you're eating, do not worry. I love eating all the time. So you can turn your camera off or back on for the photo at the end. Fantastic.
So I'll start off with the capital raising side here. Just to give you a bit of background on Cake Equity. So we're a SaaS platform, and the problems that we help founders out with is how do we actually streamline capital raising, and in fact, part of what I'll go through today is a bunch of resources which is really aimed at helping you actually halve the time that it takes to actually run a capital raise round. You know, our background and how we started on this journey is we've got one of our founders is sort of a technical founder who's worked with a lot of startups historically. The other founder is also a CFO, right? And he's worked in a family office previously for an ultra high net worth family and managed a lot of their investments. And when they actually got together and said, look, you know, we'd love to do something in the startup space, one of the things that they actually worked out pretty early on is just how difficult it is to actually run a fundraising round. And in fact, my background is equity markets. I actually ran investor relations for NAB, one of the largest companies on the ASX, obviously. But even for me, actually having spent a lot of time in equity markets and having run, you know, done M&A stuff and run capital raising and everything, it's extremely different. It's very different doing it at the top end of town, where, you know, you've got all the advisors, you've got different mechanisms you're using to run capital raising. You've got a lot of price discovery and valuation discovery that's just not available at small end of town. And the way I think about it is like, you know, even though I've got a lot of experience in that space, coming and joining Cake and doing it in the startup space is almost like learning another language, right? So our platform is about helping you, giving you a bunch of tools to help streamline that process for you. But we also do a lot of education stuff, and that's why we're here today, is to actually try to give you some tools that can help you really accelerate that process and reduce the amount of confusion. I'll start off talking about capital raise, and then we'll talk a little bit about ESOPs later on. But as I said, please ask questions as we go through the process. So in terms of framework, I'll talk a little bit about an overview of capital raising, and then I'll talk about a framework that we've actually put together, which is actually our capital raise toolkit. So we'll break that down into the sort of preparation phase, the marketing phase, and the closing phase for your round. And then I've got a little bit of information here on safe notes, con notes, and equity raise, different types of raises and term sheets. I'll do a time check when we get to the end of the raise framework, because if you want to, we can dive into the ESOP stuff there and spend a little bit of time on that, rather than going into more detail on that. I will share the slides here, and as Charlotte is recording it as well, so you'll have access to that post the presentation today. So why are we talking about this? Pretty much every startup is going to need to actually raise capital to survive this valley of death phase here. Now, very early on, it might be through friends, family, you know, the triple F, friends, family, and fools, or a pre-seed round that you're actually doing there. But most startups have to actually raise funds to actually get through that initial period until they get to this break-even point where they actually start generating revenue that's actually offsetting the costs. But even for most startups, once they reach the break-even phase, the typical phase that you'll go through is you're wanting to be expanding. You want to be expanding your product range or go into adjacent markets or go global or something like that. So generally, I've heard it described as sort of porpoising. So, you know, most startups will be in this cash burn phase and then they'll be coming out of that, but then they'll raise again because there'll be another growth horizon in front of them, which they'll want to capture. And in order to be able to capture that, they'll need to raise again. So you don't need to be, you know, particularly switched on to understand that we've been through an absolute boom in terms of startup investment. If you look at the posts on LinkedIn or any of the news covering startup raising, it's been an absolute bonanza time for capital raising. So the key message to take from this is, if you are a founder and you have a good story that you're actually selling and a good idea, you will be able to actually raise from someone in the current environment. So it is a great environment. It doesn't mean it's going to be easy. Even with all the money that's flowing around the market, you still need to work at it, and it's still going to be a time-consuming process. But there is capital out there if you are the right founders and you've got the right idea out there. So when we're looking at the different phases of capital raising, what are we talking about? So I talked about, you know, friends and family round. You could also talk about that as a pre-seed round. So what are we actually talking about typically there? So typically we're talking about a very early stage startup. It might not, at that stage, it might not even have any revenue. We're talking about a 1 to 3 mil valuation. In that round, the amount of equity that they're looking to give away is somewhere between 10 and 20%, typically around 10%. And the amount of raise in that round is they're probably raising somewhere between 200 and 400K, right? And then you get to a seed round, 3 to 5 mil val. You certainly will see some outline of valuations. You know, we've seen some seed rounds where people have like $20 million val, $50 million val, etc. They are still the outliers, although I would say in the current market, the typical val could be higher than the 3 to 5. So it might be even 5 to 8, something in that vicinity. Again, how much equity I'm giving away? Well, typically at a seed round, you're going to be giving away somewhere between 10 and 20% in order to raise, you know, 500 to a mil, or as I said, with valuations a little bit higher at the moment, maybe it's 1.5 mil. Now,
Cal, oh, sorry. Yeah. Joe just had a question. Are you talking AUD or US?
Yeah, this is AUD. Right. Yeah.
Awesome.
Yeah.
Oh, it's just in.
Yeah, and look, you know, it's actually a pretty good question because, like, you know, like you are seeing, you know, in some of the deeper capital markets and some more mature capital markets like the US, you are seeing some higher valuations in that. So you could actually potentially say that, you know, for the US, that might be actually USDs where the average actually deal size is a little bit higher. So the last point there was actually about ESOPs. What is an ESOP? Employee share option plan. So that's actually giving equity incentives for your team. Generally at a seed round, if you haven't already allocated your ESOP, and we would suggest you do it quite early on because most people are giving away equity to advisors early on, and it's a great tool to do it. But by the time you get a seed round, if you've got a sophisticated investor coming in to invest in you, they will want you to have allocated your ESOP pool. And why is that? Because if you allocate a pool to your ESOP later on, I'd say you're setting aside a percentage of your shares to be offered out to employees. They're not all offered day one, but they, you know, you're setting aside enough to actually last you through, you know, the next 2 to 3 years. Then if you don't do it before they invest, then it effectively dilutes their shareholding. So if they invest $1 million in you today, and then you allocate 10% to go to employees after I've invested in you, effectively my $1 million investment has been diluted by 10%, so it's only worth 900K. Or my percentage ownership, if I invested $1 mil for 10%, then if you allocate 10% out, then I've only got 9% ownership effectively, right? So most sophisticated investors will want that ESOP allocated beforehand. And then you've got a Series A round there. Again, you can follow in terms of the amounts and that you've got there. So obviously, as you go through that process, it's not only about the amount of money that you're raising, it's also about the investors' expectations of where your startup is up to in terms of its development cycle, it's got revenue, and its momentum that it's actually going through each of those phases. Okay, so I just mentioned dilution there. If you don't know what dilution is, this is a great example here to actually explain a little bit about how it works. And so what I'm going to focus on is this just down here. We've got a seed round. We've got a 4 mil pre-money valuation. So, and we're raising $1 million. So after that raise round, effectively the valuation of your startup is $5 million, right? So in this case here, we've actually issued 20% of shares to investors, right? And if I'm the CEO and lead founder, at this stage, I own 30% of the company, right? So my 30% of the company, based on that 5 million val, post-money val, is basically $1.5 million, right? That's my ownership there. Now, what you can see is as we go through each of these rounds, I'm giving away more equity. And every time I give away more equity, my piece of the pie shrinks, right? Okay, so I go from owning 30% to then 20%, then 15%, then 12%, right? So not great, yes, but what I'm actually betting on is as I actually raise that money, I'm able to actually deploy that in a meaningful way that increases the valuation of the business. So you can see here, by the time I get to this Series C, my actual post-money val is actually $100 million, right? So it's 80 million pre-money val plus the 20 mil I've raised. And even though my ownership percentage is now 12%, my actual value of my equity holding at that point is $12 million as opposed to $1.5 million when I own 30% in that seed round, right? So does that make sense to everyone? You understand how that works? So it's really important for you as a founder, for your investors, and also your employees to understand that as you go through each of these funding rounds, the percentage ownership will actually decrease, but you're relying on the valuation uplift to actually offset that, to actually so that your actual value of that holding, even though it's a smaller percentage, is going up over time. It's important that you as founders, when you're thinking about capital raising, you're not only thinking about this round here, you're thinking about the future rounds, and you're actually modeling out what that dilution actually looks like. Because if you get to a point where you and your co-founders have such a small percentage ownership by the time you're at this Series C, let's say you only have 5% ownership as founders, then that can be a disincentive to investors to invest in you, because they go, well, you've given away too much equity. Your key drivers of the business, you don't have enough skin in the game, right? So it's really important you actually think about this from an early point and actually understand how this dilution works and actually do some numbers, model it out. What's some scenarios on what you could look like over the next 2, 3, 4 years?
Cal,
okay. Yeah.
Sorry, Nikolai had a good question there. How do you approach valuation at pre-seed stage, or do most companies, investors use a general rule of thumb in the absence of customer revenue?
So there's a couple of things. There's two elements to this. So you can use instruments that actually avoid you having to worry too much about valuation. So if you use a safe note or if you use a con note, you don't actually have to put a price on your equity at that point in time, right? So basically how they will work is the amount of equity that they get for the amount of investment you get today, if you're using a con note or a safe note, will be determined at your next equity round, right? And so what that does is it allows you to get some more traction, allows you to get some revenue, and you're in a better position to put a valuation on the business there. And then so the investment that I give you today, if I'm investing in a safe note, the amount of equity I get for that will be determined when you do that equity round. Let's say typically it'll be within the next 6 to 12 months, right? So that's one way you can do it is by choosing a instrument to do your raise that doesn't require you to do the valuation. The other thing is there are valuation tools out there that are good for really early stage startups. Like there's the Berkus method, which is like really a more a qualitative method for actually doing a raise, doing a valuation, and there are a couple of other valuation methods that are actually included in the Cap Raise toolkit that I'll give you later on. So there are some that are actually more qualitative that you can actually use to actually help get an idea of your valuation if you're really early stage. Any other questions?
No, that was fantastic, Cal. Thanks for
okay.
And also I guess we'll go over the challenges of maybe you don't want to give away too much equity to start with to investors.
Yep. So early stage, so this is what investors want, right? So there are some great businesses out there that will make good returns for their investors over time, but aren't necessarily going to be suited for raising out of your typical startup funding pool like VCs, etc. And so this just gives you an understanding of the types of returns that investors are going to be looking for. So if you're really early stage, I'm going to be looking for 100% uplift in terms of returns year on year, right? So what does that mean? It means that when I run my next equity raise, if I've raised it at a valuation of $2 million today, or let's go back to that last example, I've raised at a valuation of $5 million. Okay, the next round that I'm going to do within the next 12 months is going to be $10 million valuation, right? And that way I've actually generated that return to my investors through that valuation uplift, right? Latter stage, 50 to 70% per annum. And then like a VC is looking for a 20x return, right? So why is that? So part of the mechanism that goes into this is the fact that a kind of rule of thumb in terms of particularly early stage investment is that if I make 10 startup investments, 7 of them are going to fall over, right? So I'm left with 3. 2 of them are going to give me positive returns, but only modest returns. And then 1 is actually going to generate the majority of my portfolio returns, right? So that's a rule of thumb that for early stage startup investing. So it doesn't mean that if your idea or your startup can't generate those returns, it's not a good business. But what it does mean is you're probably not going to be going and pitching that to VCs and getting them to invest in you if you can't show them a potential for that sort of return over the next 3 to 5 years. Does that make sense? Okay, just a couple of things here. I'll talk about this more as we go through it, but the founding team is the most important asset for your business, right? Full stop. No questions asked. And actually getting a greenfield startup off the ground and building a unicorn is like winning gold at the Olympics. In fact, a unicorn is like winning multiple golds, right? So it's like being Michael Phelps, right? So you need to make sure that you're looking after yourself. Accelerators, incubators, communities like Climate Settlement is really important. Really important that you actually understand your purpose and you tap into it, but you also really actually get your teams to tap into that purpose as well. Going through a startup is like a roller coaster. There will be times where you have the highest of highs, but you'll also have the lowest of lows. Being able to really tap into why you're doing this, not just the monetary returns. It's like, what is your purpose, right? It's really important you do that. You need to build your network, you need to build your brand, you need to get your name out there so people understand who you are, because they are, particularly early stage, they're investing in you more than anything else. Keep learning. If you're growing, 100, 200, 300% year on year, which most startups will need to do to be successful, whatever made you successful 12 months ago, some of it is relevant, but a whole bunch of it's not going to be relevant for the next stage you're at. So you need to keep reinventing yourself. You need to keep learning as you go through that process. Get the right resources to be able to do that. Learn from the best people. Get the advisors. Get the mentors. You've got a great community here with Climate Settlement. Tap into that. Tap into all those smart, brilliant people around you, because you'll need that. And look after your health and your mental health. As I said, you're the most important asset for the business. So make sure that you're actually looking after yourself as well. Don't absolutely fry yourself. It's really easy to actually do that. Okay. So I'll now go into the raise framework. As I said, we'll talk about preparation, marketing, and closing. The resources that I'm going to reference as we go through here are all in our capital raise toolkit. I'll actually share that with you at the end of the presentation, so you'll be able to go through that if you haven't seen that already. Okay, so the overriding theme here is to simplify as much as you can, right? So, you know, for example, on the capital raising side, if you go into the Cake platform, you can sign up for free. It's free for your first 5 investors, so it'll cost you nothing. We have safe note templates in there. We have con note templates in there. We have subscription agreement templates for an equity raise in there. We have ESOP plan rule templates. We've got ESOP offer letter templates in there. We've got a bunch of resources in there. So don't go and reinvent the wheel and pay someone to actually do that from scratch. Take advantage of the tools and resources in there. You know, if you're looking for term sheets, Airtree have an open source term sheet that they start every deal with, and it has a guide in terms of what's a reasonable clause for a term sheet and what's not. So go and tap into all those resources. We've got investor lists and all that sort of stuff, right? Simplify as much as you can, learn from others. Okay, so the preparation phase. So this is all about starting to actually get together the information you need to run the raise, but also preparing to pitch, right? So there's tools in here around, you know, a short pitch deck, which you'll be using to actually get your foot in the door and get investor meetings. And then there'll be, there's guides in here around developing longer pitch decks, which the purpose of those is to actually get you a term sheet and get you an investor at the end of the day. You'll need to start thinking about early on in terms of data rooms, you know, because if you get it engaging investors, you need to be prepared to actually share the information they need to understand your business. If it's a really early stage raise, then the data room requirements are pretty limited. It might be, you know, your cap table, your shareholders agreement, maybe IP employee agreements, any contractual agreements. As you're getting to later stage, it'll be more comprehensive in terms of financial disclosures, etc. There's valuation tools here. I talked a little bit about it, the Berkus method. As you get later, there's Equidem, and then obviously once you've got more momentum, you get to a DCF valuation. It's also looking around at what other people are raising in the market as well. There's financial models in here. There's legal docs. There's resources in here for finding investors, right? So Airtree's open source investor list is a great resource for you to actually tap into to actually start building out that investor list. So you'll need to be thinking about how much you should be raising at this point in time. And I think there is a bit of a trap that people can fall into, and they kind of go, oh, I just want to raise as much as I can, and I want to maximize my valuation at this point. In reality, what you should be doing is actually going, what's the next logical set of milestones for your business? And then how much do I need to actually raise to actually hit those milestones? Obviously give yourself a bit of buffer, but then reverse engineering to actually come up with the evaluation of that. So if I say I need to raise $1 million to actually get to my next lot of milestones, I'm prepared to actually give up 20% of equity to actually do that at this round. Then my valuation that I'm actually aiming for is a $5 million valuation, right? So you're sort of backward engineering it. Be wary of taking excess capital. So the thing it will do is it means more dilution, but it also means more expectations in terms of meeting growth and revenue targets. So yeah, be wary of actually just going, oh well, yeah, I only really need $1 million, but I can raise 3 mil, so I'm going to take it all, right? Be wary of particularly early on doing you know, long 5-year forecasts for your business, right? Because really it's about you being able to actually develop a forecast which actually shows you how you're going to deploy that capital, what resources you're going to actually spend it on, and then what the milestones you're going to hit, be it number of customers, be it building your MVP, or be it a revenue milestone that you're going to hit. So avoid, if someone comes in a really early stage and says, I need a 5-year financial model that's super detailed, then it's probably a good signal for you to maybe start running the opposite way, because you know, that level of detail for most early stage startups, they really don't have any. It's not going to be valid beyond 2 years. So a 2-year forecast is probably sufficient, particularly for most early stage raises. Okay. So then we're going to get into the marketing phase. So this is when you're going to be actually the tools that you actually develop through that early stage. You're then going to be actually deploying those. So you're going to be sending out pitch decks. You're going to start having meetings, having built your investor list, and then you're going to start to be actually talking about deal terms and those sort of things. So one of the things that you need to actually understand as you go into this marketing phase, and this is what you need to be building in that early phase, is that going through a capital raising process is just like building a sales funnel, right? So if I want, you know, 5 paying customers on Cake at the end of the day, I probably need to be talking to 50 up front, because a bunch of those may already have a solution, or maybe they actually don't want to do buy your product, or maybe they're not ready to raise at this point in time, right? And then you might have others that actually go through the process and they're unsuccessful in raising, right? So they're not ready. But basically, in order to actually land the 5, I probably need to start with a target list of clients that's 10 times that. And it's the same for your capital raising as well, right? So sit down, have a think about how much capital I need, what's the likely average check size, and how many investors am I going to need to fulfill that round, right? And then you need to work backward from there, right? So we've got an example here of starting with an investor list that has potential capital of 10 times the amount you need to people to engage early on, right? And then you want to get to this point where you've got a qualified interest list of 3 times the cap, that you're 3 times covered the amount that you need to land, right? And then if you've got that, then you'll probably get to your 500K, which is the actual target that we've got here of the actual amount of investment we need. And build a model like this and make sure you've got enough investors early on, because if you don't, you won't get to raise the amount of money that you need.
I want to jump in here, Cal.
Yep.
Back on that one. So this is actually the template I shared with Jason.
Yeah, okay.
Although we have it in dollars. A really critical principle that vast majority of Aussie startups, I think they make first time they make they do 2 things which make it much more challenging. First of all, they wait till the last minute and think, now I'm going to raise capital. Let me go and raise revenue. The reality is that to build the relationships up, like vast majority of investors will want a relationship for at least 3 months, preferably 6 months, at least 10 meetings. Like, it takes a while to build a relationship, and you should want to build a relationship too. And the other mistake they make is when they start, they do the opposite of this, which is they're raising $1 million, they get one person in for 25K, and they try to build up interest from there. Yeah. Whereas you should try to build up broad, lighter interest, and then use that, because then you've got competitive tension, which I'm sure Carl's going to cover a bit of. But I really, really want to emphasize that build relationships early, like immediately, because they take a while to build. And you want to build good relationships. You don't want to rush in and just get checks. It just doesn't work that way. It's much more like a marriage than it is I think Lauren Kaplan did that really quite well last time. But yeah, just want to emphasize that point that Cal was making.
Yeah, that's a great one. I think the other one, which I'll sort of talk, that's really important while we're actually focusing on investors, is, you know, they're going to do due diligence on you, but you need to do due diligence on them as well, right? So ask them the questions, you know, how active are they investing? Are they investing in climate impact type style startups? You know, what stage are they investing? Even if they tick those 2, maybe they don't invest in really early stage and you're really early stage. You know, it's really easy to waste a bunch of time talking to people who are never really going to invest in you. So you've got to make sure you've got a quality list of people you're targeting, and ask them those questions about, you know, to understand whether they are a realistic investor for you at the end of the day. So preparing a pitch, I said this earlier on, but really, you know, particularly in early stage rounds, the most important thing is you, your founding team, and your vision for the problem you're trying to solve, right? So that's the most important thing. And if you actually look at like these mission statements for some of the top investors, you got Blackbird there. We invest in the wild of hearts with the wildest of ideas right at the beginning. So they're not saying we invest in quantum computing or we invest in, you know, a particular. So it's all about the people and the ideas. And so it's absolutely critical that you actually communicate that first and foremost, right? And so what they want to see is that, you know, who are you and your founding team? What are your unique insights to solving this problem? Why is now the right time to actually solve it, right? And what are your unique insights to actually solving that problem, right? So that's the critical things that you really need to focus on. And Mick touched on it as well. You need some FOMO, right? You can't just have one investor and then actually hope everyone's going to pile in behind them. You need to be able to create some tension there and some FOMO about them missing out. And that means putting a deadline and actually asking them, are they investing or are they not investing? You can have ongoing conversations with investors forever, but if you never actually put a deadline on when you're closing your round out, you never actually ask them, are they in or are they out? It'll just continue to be a nice coffee meetup, you know, and you won't get the money out of them at the end of the day. So where are your investors likely to be? Early round, they're going to be from founders, you know, could be a bootstrapping, a side hustle, etc. in that sort of friends, family, and the pre-seed round. There are family offices, angel networks out there, more and more of them all the time. You know, Cheryl Max just set up Aussie Angels. Southern Angels down in South Australia are pretty active. Perth Angels, Angel Loops. There's family office groups there as well. And we're seeing more and more people come into the ecosystem. So this is by no means an exhausted list, but it's just trying to give you an indication of who's out there. You've got the venture capital space, you know, you've got the really well-known names, but we've got more and more coming in to the space. And particularly, there seems to be more focused around earlier startup raises now, even like, you know, Blackbirds and that raising and committing to put a certain amount into seed round. But then you've also got people like, you know, EVP and Afterwork, who are actually investing even earlier than that as well. Like Afterwork Ventures, for example, is a really early stage investor in cake, right? So understand who's out there. 1013 Investment Syndicate invests early, but also does follow on as well. And then you've got some platforms and advisors out there. So you've got the crowdfunding platforms like Equitize, Virtual, and VentureCrowd. You've also got platforms out there like Wholesale Investor, who will actually, their goal is to actually help you prepare to actually pitch and then put you in front of an audience of sophisticated investors for you to be able to pitch to. And then you've got people like Industrial Capital, who's an advisor who has like a network of you know, family offices plus VCs or whatever, who will help you step you through that process and help run a raise for you. Some VCs do not like having an advisor in between you and them. And I had a conversation with Rain Ong, who's, you know, a very prominent early stage investor, about that at South Start last week. So you do need to be aware of that if you are using an advisor. But I do know a lot of startups who have used them quite successfully to help them get those early stage rounds away. So that's sort of the marketing phase. So yeah, really think about, make sure you've got your resources ready before you actually run that, start talking to people. Make sure you've got a really comprehensive list of investors. As Mick said, allow enough time, right? You know, typical, if you do it well, it's going to take you 6 months. It's really 3 months of the marketing phase and then another 3 months to actually close your deal. We closed a funding round last week, which was last year, which was only announced last week. Some of you may have seen it. You know, even after we actually closed that round, it still took us 2 to 3 months to get funding out of some of the sources, right? So because we were raising overseas, so just you need to allow for that when you're thinking about when you want the money in the door. It takes longer than what you think to actually do that. So you're closing the round. This is a phase now. So you'll need that data room to be able to be shared with people. You'll need things like the Cake app to actually streamline the sending and signing of those agreements. You know, there'll be your subscription agreement if you're doing an equity round. There'll be term sheets. There could be side letters that are going around with those things. You need to issue share certificates, or if it's a safe note, issue your safe note, etc. You'll need to update ASIC. There's a whole bunch of stuff that needs to be done when you're actually closing the round as well. So don't forget about this. It's not just about when you get that yes. You need this stuff ready to be able to actually close the round once you have the thumbs up or the handshake from your investor. Now, I'll just pause there. Are there any sort of questions you want to go through before I go into the sort of types of raises? So I will say, like, there's a lot of resources there. So, you know, they're all in the capital raise toolkit. So work through them in a systematic way. And look, you know, it does take time. So you need to be realistic about actually allocating enough time to actually be able to run through a capital raise process. So it is really, really important that, you know, if you've got co-founders, that one of your founders takes a lead on that and they actually allocate a decent chunk of time to be able to actually run that raising process.
Cal, Amanda has a question around the agreements on the Cake platform. Amanda, do you want to ask the question?
Thanks. Yeah, I think I just mistyped it. Cal, thanks for that. I was just wondering, can you use bespoke agreements on the platform, or do you have to use kind of Cake templates?
No, you can use them. There's two ways you can do that. So you can either upload agreements into the Cake platform, and so we actually have a contract engine built into that. What we typically find is, particularly with ESOPs, you know, if someone has an existing offer letter and plan rules, they'll actually build that into our contract engine, and it really streamlines sending and executing those offers. And those offers are really complex because you've got all the vesting rules and all that sort of stuff in it. For the equity raise, what we typically see is people will either use the templates that are in there. You can amend the template, so you can change terms in them within the contract engine. Or the other thing, particularly for later stage rounds, is people will often actually, because there's a lot of negotiation on the subscription agreements and the deal terms and all that sort of stuff, they'll often actually execute it offline and then upload the completed agreement as part of the raise when they're actually setting it up on Cake.
Great, thank you.
No problem. So just time check, we've got a bit over 15 minutes, or sort of almost 20 minutes. Do you want me to go into the types of raise instruments and cover a little bit on term sheets, or would you like me to cover off ESOPs? I'm happy to do whatever you'd like. I'm just sort of conscious of time.
Shall we have a show of hands, or maybe just put in the chat? I mean, we do have later in the week, Mick is doing a cap raising workshop as well. So maybe it would be good if you could cover off the ESOPs.
Charlotte, yeah, cool. Can I ask a question?
Absolutely. Is that Joe? Go.
Hey, gang. Look, Cal, I think this is a bit of a broad one, but say you were to start today, right? Fresh as a daisy.
Yeah.
And today was the first day of the rest of your life in a startup that's pre-seed. What would you be doing now? I know you've gone over a big list, but is there any things that you would say are critical that most miss? As in, what is the thing that is like your number one? Here's who we're starting. Here's the first thing I'm going to do on my list today.
So I think really early, it's things like you know, really think about your founder equity, right? If so, are you saying you're not raising right now, or like just setting a company up? Is that what you're talking about? Or
no, I'm putting yourself in the hot seat here. If you're the one who's having to do this all today, and you are at pre-seed, what would you be doing? You're saying look at equity, but I guess.
So the first things I would be doing is I would be actually getting my my frameworks for the startup set up properly from the start, right? So obviously you're going to need an incorporated entity. You're going to need a company, not a trust. You're going to want to actually think about your founder equity, right? So most startups will have more than one founder, right? So are you going to just give, is it going to be a 50-50 equity split? That may be right, but maybe that actually isn't right. Maybe one of you is actually bringing more value to the relationship, or is actually going to spend more time working in and building the startup than the other one. So maybe it's a 70-30 equity split for your founders, right? And then think about things like founder vesting, right? So, you know, again, if you have a 50-50 equity split for two co-founders and one walks out after 3 months, and the other one is doing all the work from there on to actually build value, but one of the founders still has 50% equity, that's not a very equitable position to be in. And that will also be an issue for investors coming in, because they'll see a massive amount of debt equity on your cap table. So early on, it's thinking about things like that, right? So you'd want a shareholders agreement in place. You're probably going to be getting advisors on and maybe people doing sweat equity. Do it properly from the start. So get an ESOP set up, do it through the Cake platform. It's pretty cheap to do it that way, and really it can be done quite effortlessly. So you're actually giving equity to people properly. They're valuing the equity that you're actually giving to them, and you know, not only for those advisors and that, but as you build your team as well. So they would be things that I'm doing. And then yeah, like you know, if you're running like a pre-seed round, make it as easy as possible. So, you know, if you can use a safe note, use a safe note, right? It's the simplest instrument for you to be able to actually use. Use a template that's on the Cake platform, right? You know, you need help, legal advice to be able to help you through that process, and accounting advice to be able to help you through that process. Tap into like a lawyer or an accountant who knows what they're doing in the startup space, right? We have a panel of them. If you've got your own, fantastic. But like, you know, don't go and get your uncle's, you know, mate who's a litigation lawyer, has never done anything in startup land. It's the worst thing you can do. Go and actually find someone and pay them who knows what they're doing in this space. It'll save you so much time and energy. Does that give you a bit of a kind of overview?
Absolutely. Thanks so much. Appreciate it.
No problem.
Cal, I just put it to the Crown here. If they'd like to cover ESOPs now or continue with Cap Raising.
Yep.
Had one reply if you can cover ESOPs.
Yeah, cool.
If everyone's
no problem.
Okay. Yeah.
Yep.
That'd be wonderful. Thank you so much, Cal.
No worries. So I'll just switch over presentation. You can see this ESOP one now. You see this one?
Yes.
Yep.
Okay. So, as I said, ESOP stands for Employee Share Option Plan. They are just a mechanism of actually giving equity to your team. Why are they great for startups? You know, like building a great team is one of the most difficult things to do, particularly in a very hot market like this. So not only being able to actually give them, you know, you obviously need to rem people with salary, but being able to offer them an ownership upside in the business as well is absolutely critical to actually being able to attract and retain great people as well. It'll help you preserve your runway, because you can basically offset some of the, you know, the salary spend with the equity incentives. Helps align increased productivity, allows you to actually share your success with your team, and it's certainly a big factor that people report. Make you better looking. I'm not sure whether that's right or not, but there's an enormous amount of value in them. So who can you use ESOPs for? It's really flexible in Australia who you can actually use them for. You wouldn't usually use them for founders, so they would normally be allocated shares, and then, as I said, you may actually also want to think about founder vesting, where if they leave after a short period of time, the startup can buy back part of their equity holding at a nominal value, to stop that scenario where you've got, you know, 50-50 founders. One walks out the door after 3 months but still owns 50% of the business. You've got advisors and board, great for providing equity incentives to advisors and board, and will typically be able to substitute having to pay them cash via an equity incentives. Initial employees, yes, absolutely would be looking at that. And then as you scale your team, setting up an equity incentive framework, it could be like Cake. We provide equity incentives to everybody in the business. There are some businesses out there will only provide them to senior management or senior leaders in the organisation. It's really flexible, so you can actually pretty much set it up however you want, but you will want to actually put some sort of framework around who you're going to give incentives for, how you're going to set those incentives. Is it going to be a percentage of equity ownership in the business? Is it going to be a percentage of their salary that you're going to give them as equity incentives? And I'll go through a couple of scenarios around that. You can use them for contractors. Sweat equity is effectively the same thing, so you can actually absolutely use that. It needs to be to an individual though, basically. So you couldn't actually go, oh, well, I'm going to pay Ernst & Young with an ESOP. It won't work in that scenario, but in most cases, the contractors that you're using will be individuals. And so you can absolutely use ESOPs as part of their incentive mix. What's vesting? So a little bit of terminology here. So generally how employee share option plan works is I'm giving my team, I'm giving my employee a grant of options today, right? So I'm granting them options today, but they can't actually turn those options into shares until there's been a vesting event, right? So what happens typically for a startup is vesting will be based on time, right? So, and what this shows here is that this is actually data from the startups that are on Cake portfolio. So you can see 74% of the option plans on Cake have a 12-month vesting cliff period, and then thereafter they actually have 63% of them have time-based vesting over the next 3 years, right? So what does that look like for the employee? You give me 40,000, you grant me 40,000 options today, right? But none of those options vest for 12 months. And then after 12 months, I get 25% of the options vest, right? So if I leave within that first 12 months, I get no value from those, right? After I've been here for 12 months, I've got 25% of that 40,000. So I've got 10,000 options invested, which means that I can actually turn those into shares, and I have an ownership in the company and value from that, right? And then the remaining 30,000, so the remaining 75% that didn't vest after that first 12 months, vests in quarterly increments over the next 3 years. So what does that mean? In order to actually get the value from all of those shares that you've granted me today, I need to be there for 4 years, right? So it's a great incentive for me to actually stick around. And it also correlates to me generating value in the startup over time, right? Because, I don't generate all the value day one. I generate value progressively over the time that I'm with the startup, right? So that's a typical vesting structure that we see in startups. So it's 4-year vesting with a 12-month cliff. And then, so if I left after 2 years, I would actually have 50% of my options vested by then. I would be able to exercise those, turn them into shares, and I would have 20,000 options, right? So that's a typical vesting structure that we actually see and how it works for most people. You can do manual milestones, or you can do like a Cake, for example. We actually have a revenue-based milestone, which is going to trigger an option grant for the whole team, right? So they are really flexible. Pretty much anything you can think of, you can come up with as a trigger for vesting. It could be KPI-based or doing a certain number of hours work-based or whatever. But the most common one we see is actually time-based vesting over 4 years. Any questions on that?
Yes, Kate has a question. Would you like to jump in there, Kate?
Sure. So my question was, like, obviously I understand vesting, but where for the first 4 years, obviously there's a large chunk of shares that are unvested. And in many cases, well, in every case, the company will be incorporated with shares, and often a founder or the founders will incorporate the company having full ownership of the shares. And then when you go into fundraising, you start allocating different parts of equity on the raise.
Yep.
But where does the balance of power and the shares sit for those unvested shares? So as an example, at the moment, I've incorporated a business because, you know, I need to do that to just be able to have a website and an email and a bank account and everything. And at the moment, I own 100% of that.
Yes.
But when I go into a raise, I'm obviously going to need to have a founders agreement, and that those founders shares would ideally vest. But then what happens to that control and ownership of the business? And I know it's kind of a legal question, but it's one that I kind of grapple with.
So that's the control and ownership of the business is something that you will want to actually consider as you go through each of your funding rounds, right? So it's usually more a funding issue than it is an ESOP issue, right? So that would be the first thing I would say, right? And so when you actually have investors coming in, like, you know, depending on the amount they're investing and all that sort of stuff, they may actually ask for like a board seat in return for the investment. And that's something that you will negotiate as part of the terms of those investment rounds. Okay. So that's it's generally more of a capital raising question than it is for the ESOP. Now, if you're using the startup concessions, there's really generous tax concessions in Australia for startups using ESOPs, right? One of the things with that is that if you're using those startup concessions, the options need to convert into ordinary shares, right? So ordinary shares are going to be voting shares in Australia, right? So if I, as an employee, have options and I convert them into shares, then I will have voting rights, right? Because I'm an ordinary shareholder. However, usually the amount that's allocated to ESOP wouldn't give like the ESOP holders the ability to be able to actually control the business, right? And it wouldn't give them the right to a board seat, which could influence, you know, the strategic decisions for the business as well, right?
You raise a really good point. You're talking about ESOP and ESOP shares, and I think my question relates to the founder and equity piece. So I might come back and ask you that in a different forum, if that's okay.
Yeah, no, that's fine. Yeah, reach out online.
We have about 5 minutes left. So I was just thinking, if there are follow-up questions, can we reach you via LinkedIn or your email?
Yeah, or my email. I'm happy to give you my email. I'm happy to, yeah.
Fantastic.
Happy to do an office hours with people. That's no problem at all.
You're incredibly generous. Thank you, Cal. So I'll let you keep going.
These are just some examples of what's actually happening and how you might think about structuring your option grants. So this is giving you comparisons of how equity grants have changed over time. You can see here, like, you know, we've actually seen an increase in percentage of equity actually given to employees between 2018 and 2021, which is kind of, you know, reflecting this really competitive tension for talent across the tech sector. But the other thing to understand here is, you know, the amount of equity you're giving to employees. So this is a percentage of the fully diluted equity, right? So percentage of the overall ownership in the business, right? So you can see that the amount of grant scales based on the seniority of the role, which is what you will expect, but it also based on the type of role. So you can see here tech roles, like in 2021 for a senior tech role, you've got like an average allocation of 1.18% equity, right, of the ownership of the business for those senior roles. Whereas if it's a non-tech role, even if it's a senior, the actual grant amount is actually less. So it's about half, right? So these are the sort of things you need to be thinking about as you actually put together the framework for how you'll actually allocate options across your team. Here's an example here of some different ways of thinking about the allocations. So you can see here, you got an employee with 100K salary. You want to give them 20% of their salary in options. So the option value is going to be 20%. typically, you're going to look at that over a period of time. As I said, you're going to give them time-based vesting. So you've got 60,000 option value over 3 years, right? So that's what you'd be actually looking at in terms of the option grant. So what does that actually look like? So if, you know, the valuation of the business was at $2 million, then the employee is effectively getting 3% equity. As that valuation goes up, if it was $4 million, they'd get 1.5%. If the valuation of the business was $8 million, then that equity grant would be worth 0.75. So just have a framework. If it's a percentage of your REM, think about that. That might be for a mid-range employee, might be 20%. If it's for a more senior role, one of a really critical role, that could be 50%. If it's for a more junior role, it might be 5%, right? So you need to actually work through and just have a bit of a framework in terms of how you're going to allocate these options, and then model it out. Like, it's not just the amount you're giving now. Think about the amount of employees you're going to have in 12 months time, 18 months time, 2 years, and how you're actually going to allocate out your pool of options as you go through that period. I've talked about vesting. I think, I won't go through a lot of that there. I think I've gone through quite a lot of it. I will share this so you'll be able to go through it. I think one of the most important things about it is, I've seen ESOPs be almost as much a disincentive as an incentive, because the employees don't understand the jargon, they don't understand what they're being given. And the last thing you want to be doing as a founder is giving away equity and not having your team understand and value it at the end of the day. Like, that's just insane, right? To give away equity and not have it valued, right? So the tips with this is, there's a technical piece of how you structure the grants and how you actually set up your plan rules and all this sort of stuff. And Cake can really help with that sort of stuff. But the people engagement piece is equally important, right? As a technical side of it. You need to actually really communicate with the team. Now, we've got some great resources I'll share with you in terms of presentations you can use to explain what ESOPs are to your team, right? But then also having them on a platform like Cake, where they can actually see the vesting over time. Every time there's a vesting event, I get a notification saying, hey, congratulations, Callum, you've just received another 5,000 options. That's awesome, because it brings me back to the value that's been created through it. When you're running raise rounds, talk to your team and link back to the value of their options to that round that you've just gone through, and the value that's been created. That piece is as important as the technical piece. And so, yeah, I think that's probably where I'll finalize it. In terms of the Cake platform, we have plan rules in there. We have offer letters in there. Literally, you can set up an ESOP and be sending offers within like 30 minutes on the platform. It's really easy to do. If you need the advice around actually going through your plan rules and understanding what happens if someone leaves and that sort of stuff, we have legal people we can refer you to. You will need a valuation if you're relying on the ESOP concessions. So we have accountants that we can refer you to, can do a compliant valuation for you as well. But they'll just help you streamline that whole process and get it set up properly from the start, which is really important you do that.
Thank you so much, Cal. Mick's just put in the comments, he's done over 50 cap tables and ESOPs, and can vouch for how incredibly useful the Cake templates are.
Thanks,
and as members of Climate Salad, you also have access to the perks and partnerships with Cake. First 5 employees and investors, I think, free for that investment. ESOPs. Really great comments and questions coming through. Incredibly great information, Cal. Thank you for letting us dive into your brain and also just sharing so much of your incredible intel. We can get in touch with you via
get in touch via email or LinkedIn, however you want to reach out. So you can share my details, Charlotte. If you haven't gone on to Cake, go on to Cake, sign up. It's really easy to do. It'll take you like literally 2 minutes to actually sign up. And then boarding session, because our CS team is incredible. Like, and they are used to dealing with people who, you know, need help navigating their way through this. So do, you know, definitely do that. Book an onboarding session, and they'll help you tap into all the templates that are in the platform and everything. And then have a look at the resources that I'll send out. The Capital Raise toolkit, the kit, the ESOP toolkit, because it has some great stuff in there that'll help you navigate through all of those pieces.
Thank you so much. I will ask everyone to turn their cameras on, and I'll get a screenshot, a group shot, as we usually do. I'll press stop recording too. Thank you, Cal. Wonderful. I don't know, what are we going to do? Like a Mick big smile? Are you excited?
Hey, that's my trademark.
Oh, okay, sorry.
Whoa. Yeah, I don't know what's a cap table ESOP cake, eating cake.
Okay. I know. Delicious. Okay.
I am. We're going to choose the own, man.
Beautiful. Thanks so much, Cal. Do you have a Calendly link or?
Yeah, I'll send through a meeting link as well. Yeah.
Fantastic. Thank you so much for coming on board. Don't forget our Melbourne Climate Tech Showcase, as well as the Cap Raising Workshop with Mick. Mick?
Awesome.
And the way to balance diet is a bit of salad and a bit of cake. Just want to say that. So it's, it works out well.
Oh,
sounds good.
Thanks
Cheers,
so much,
Mick.
everyone.
See you, Jackie.
Thanks, team.
Thanks, Charlotte. See you, everyone.
Salad, love it.
Talk soon.